Welcome back to Positions Taken, where every call was backed by data, not noise. Let's break it down. The U.S. stock market is down 4% in Q1 2026. Tech stocks lagged the broad market, and Morningstar says the tech sector is now trading 14% below fair value, the most undervalued it has been in years. Today, I give you 3 tech stocks Morningstar rates deeply undervalued right now, each with a wide economic moat, each with a specific fair value target, and each with a clear reason the discount exists and why it is temporary. Stock 1. Broadcom, ticker AVGO. Morningstar rates Broadcom 41% undervalued versus their $650 fair value estimate. Wide economic moat. Current price around $386. A $264 gap to fair value. Why is it undervalued? Broadcom gave weaker forward guidance earlier this year, spooking short-term traders. And the market is fixated on NVIDIA while missing the broader AI infrastructure story. Broadcom builds custom AI chips for Google, Meta, and Apple. It owns the networking infrastructure inside every major AI data center. And its software division from the VMware acquisition generates recurring enterprise revenue most analysts still undervalue. EPS, expected to nearly double from 4.91 this year to 9.02 next year. 62% upside if the stock closes the gap to fair value. Best for investors who want AI infrastructure exposure beyond NVIDIA at a 41% discount. Stock 2. Alphabet, ticker GOOGL. Even after a triple-digit run this past year, Morningstar still rates Alphabet 16% undervalued, with a $433 fair value estimate. Wide economic moat. Current price around $363. Why is it undervalued? 2 fears: DOJ antitrust risk and the narrative that AI will destroy Google search. Both fears are real, neither is fatal. Morningstar raised its fair value to $433 after Q1 2026 earnings showed revenue up 22%. Operating margin expanded 220 basis points. Gemini API sales hit $15 billion in annualized revenue, up from $9 billion just 1 quarter earlier. Google Cloud growing 28%. Waymo is the only fully commercial autonomous robotaxi service at scale. YouTube is becoming a sports streaming powerhouse. If the antitrust case ends in a fine rather than a structural breakup, the path to 433 and beyond is clear. Stock 3. Guidewire Software, ticker GWRE. The least known name on this list and the deepest discount. Morningstar rates Guidewire 44% undervalued with a $220 fair value estimate. Wide economic moat. Current price around $123. Why is it undervalued? Most investors have never heard of Guidewire. It provides cloud-based software for property and casualty insurers, claims processing, billing, policy systems. It sounds boring. That is exactly why it is cheap. Guidewire is executing a land and expand strategy with no credible competitor. Switching costs are massive. Once an insurer integrates Guidewire, replacing it takes years and hundreds of millions of dollars. This is a textbook wide economic moat business. The 44% discount exists because it is invisible to retail investors, not because the business is broken. The honest reality check before you buy. All 3 are undervalued for reasons that are real: weaker guidance, antitrust fears, low name recognition. Morningstar fair value estimates are not price targets with a timeline. They could stay undervalued for months. But if you have a 3 to 5 year horizon, buying wide moat businesses at a 40% discount to intrinsic value is historically one of the most reliable paths to wealth creation in the stock market. Hit subscribe for weekly stock breakdowns. Drop a comment. Which of these 3 are you buying first? See you next time.